Hello and welcome to From the Newsroom. I am Anup Roy. Today again the markets fell. Currency, the rupee touched 63 a dollar, bond yields rose to 5-year high, and stock markets tumbled. To discuss more about it, we have with us Dinesh Unnikrishnan, who will take us through what happened in the market. Hi Dinesh, welcome to the show. Can you please tell us why this kind of pessimism is there in the market? Why I believe that the stock market fell for the second day, and rupee, it seems there is no stopping where rupee is tumbling to. Can you please tell us what is this happening?
Yes, Anu. So basically, what we have seen today is a continuation of the last week's trend. As you rightly mentioned, Friday was we saw a collapse of 750 points in stock market, and today things haven't improved. On the contrary, it has worsened, and the pessimism which you mentioned, that is increasing, that has spread to across markets. The most important element that one should notice today is that the bond yields have started responding in a dramatic manner, both on the long term and on the short term sides, as well as the rupee. Despite the the whole set of measures which RBI has been taking since mid July, it hasn't helped. That's what one should think, looking at the fall of the rupee, and on the liquidity part. Actually, the liquidity tightening measures which RBI has adopted so far to drain excess money from the system and curb speculation is impacting the cash positions in the banking system, and the interbank call money rates have shot up to over double digits, into double digits now. So, the beyond the usual reasons, that is the economic slowdown, lack of fresh investments, slowing exports, what one should notice today is the spread of panic. There is no certainty among the financial markets that this government will be able to revive investment sentiments, or the central bank will be able to put a stop to such a sharp decline in the currency, which we have seen only in the time of Asian crisis before this. So people are helpless, and this is reflecting in the markets. So Anup, you have been closely tracking the bond markets. So today, if we have seen an unprecedented surge in the bond yields at 5-year highs. Could you just tell us what is exactly driving the bond market besides the normal reasons?
Yeah, sure. Bond market, the bond yields are rising because that's what RBI wanted to. At least in the short term, RBI wanted to shorter tenure the yields to rise, so that money becomes costly, and speculation in the currency market can be curbed. Again, another benefit of rising interest rate in the short term is that FIIs will be interested in buying Indian bonds and invest in the market because they get higher yield. Uh, However, what is happening is that by increasing the interest rates, the perception in the market is that this will impact the growth. And FIIs possibly could be thinking, since the growth will be impacted, there is no point investing here. They are taking away their money. So only the rise in the interest rate is no more a cookie to financial investors of the developed countries. So RBI probably, government and RBI should uh, control two core issues, that is current account deficit and long term growth prospect. Unless that is happening, FIIs most probably will like to shun India. That's what is happening. And also, the short term rates have risen for one today, particularly cash management bill has risen for one particular reason. Is tomorrow there is a bond redemption of 11,000 crore, and again on September 3rd there is a bond redemption of 46,000 crore. Government needs that money at whatever cost need be. So they paid some 12% interest for short-term cash management bill. Also, Dinesh, I would like to know from you, what is the outlook for the rupee and bond market, and the markets as a whole? Do you think that this is going to get solved in the immediate period, or we have some pain left?
At this stage, it's anybody's guess when the markets will revert to the positive path. It all depends on how soon the economy can revive. how soon the government will be able to instill investor confidence and get foreign investments to country. All depends upon that. Yeah.
And also, I believe that this rising bond yield will impact banks' bond portfolio a lot, and they will have to provide for a nominal loss, mark-to-market losses. Can you please shed some light on that?
Yeah, that's right. This quarter, particularly when the bond yields have significantly surged, banks will see a hit on their earnings because, banks will have to set aside money in the form of provisions for what they call the mark-to-market adjustments. So this will this will result in significant erosion in their treasury revenue that is estimated to be around 45,000 crore for Indian banking industry.
Okay, thank you, Dinesh, for that. With this, we conclude today's edition of From the Newsroom. For more, please log on to www.livebin.com. Thank you.